What does a threatened shutdown of the Strait of Hormuz mean for your portfolio? Asia-Pacific stocks slid as energy supply risk jumped and investors braced for a longer bout of uncertainty. Here's the context. Iran's new supreme leader, Mojtaba Khamenei, said the strait should remain shut. Markets heard higher odds of disrupted oil flows. That pushed a risk-off tone across Japan, South Korea, Hong Kong, and mainland China. Trading showed caution as investors waited for upcoming economic data and policy signals. Cyclicals and exporters lost ground, while defensives held up a bit better. Energy-intensive industries, transport, and select consumer names weakened on fears of rising input costs. Why does the Strait of Hormuz matter so much? It is a key choke point for global crude and refined products. Any sustained disruption can tighten supply quickly. That tends to lift oil and shipping prices and add volatility. Higher fuel costs feed into headline inflation, and that can sway central bank decisions as they balance growth with price stability. The timing adds to the stakes. Markets are passing the inflation and rate path into 2026. If energy costs rise and stay firm, disinflation could slow. That would complicate plans for rate adjustments and keep financial conditions tighter for longer. Equity valuations that benefited from easier money may face pressure just as input costs rise. Not all companies are exposed in the same way. Firms with pricing power, effective hedging, and solid balance sheets are often better positioned to absorb swings in fuel and freight. Sectors tied closely to energy prices and global trade, like airlines, logistics, chemicals, and some durable consumer goods, tend to feel the pinch sooner. On days like this, you can see the market preference drift toward quality and resilience. So, what can you do? Stress test your portfolio for a higher oil scenario. Ask how a jump in fuel and shipping costs might hit margins for your holdings. Favor businesses with clear pricing power, strong cash flow, and manageable debt. If you hold travel, transport, or manufacturers with thin margins, review whether the thesis still works if input costs rise. Keep diversification in place so one shock does not dominate your returns. And stay data-dependent. Watch inflation prints, central bank guidance, and corporate updates on costs, hedging, and demand. In volatile periods, steady process beats bold predictions. Manage risk, focus on quality, and be patient with entries. Read the full article at finlitica.com.